A very good afternoon to each and every one of you. Firstly, thank you very much for this opportunity for NSE to present our views and to share our story. I want to particularly thank Korea Exchange, who've been such great friends of the NSE and of the Indian people. This trip is so warm. I am so glad that I'm in your midst today. I'm here to share the story of exchange-traded currency derivatives and what we saw in India. Firstly, I'll talk a bit about the National Stock Exchange, as many of you may not be aware of the NSE story. The NSE was the first exchange in the whole world to introduce automated screen-based trading. It was not the NYSE or NASDAQ or London Stock Exchange or Hong Kong or anybody else. It was NSE that introduced online screen-based trading for the first time in this world. We are the largest derivatives exchange for 5 years on the trot from 2019. In 2023, we were also the largest stock exchange in the world for currency futures and options. On a normal day, we receive about 22 billion order messages, and we process about 250 million transactions. These are confirmed trades executed during the day. And the economy of India, which was the poorest when India became independent on the 15th of August, 1947, is today the fifth largest economy in the world. And the size of the economy is about $4.1 trillion. And the market capitalization of all the stocks on the NSE is about $4.5 trillion. The NSE is not owned by brokers. It is the first demutualized exchange, which means it is owned by institutions and it is run by professionals. NSE is famous for many products. But I'll just talk about Nifty 50. Nifty 50 is a popular index from the NSE. We have many indices today, but we have derivatives contracts on 5 indices. Nifty 50 is one of the most successful of those 5 indices. Apart from Nifty 50, we also have Bank Nifty, Fin Nifty, Mid Cap Nifty, and now Nifty Next 50. Let's spend a few seconds on why currency derivatives was important for India. A consistently growing Indian economy has seen growing imports and exports, particularly software and IT, where India became a superpower in the 90s and continues to be a dominant player. India has been a recipient of the world's capital for a long time, more than 30 years. India today has a lot of affluent people, and this is growing all the time. And you will find Indians in every part of the world. And there are Indians who are working in other countries. There are also Indians as tourists everywhere. Indian students can be seen in almost every part of the world. And also there are businessmen who keep on traveling. And therefore we felt that currency derivatives is a product that will do well in a market like India. There was also a growing demand for fairness and transparency with respect to price discovery and better price discovery, because banks who were permitted to do currency derivatives on an OTC basis used to charge hefty commissions. That was also one reason why this product was going to be successful. Now, currency derivatives were certainly going to enable superior price discovery. And like I said, in India, only authorized dealer banks, Category 1 banks, can offer this product to clients having underlying exposure. But on the NSE, currency derivatives can be accessed by trading members, foreign portfolio investors, or FPIs, banks, corporates, importers, exporters, and individuals. Liquidity was going to be based on credit limits in the case of the banks, but on the exchange, margins equalize everybody who is on the exchange platform. On the exchange, accessibility is high and very easy. There's only exposure to the clearing corporation, which means everything is guaranteed, so there's nothing to worry. High transparency, standard contract specifications, and particularly small participants found that exchange-traded currency derivatives are extremely easy to trade on, and they were very happy with the results. Consequently, exchange-traded currency derivatives started becoming popular from the time they were launched. So we first launched in 2008 the USD INR contract, and then gradually added another 6 currency pairs apart from the USD INR. So we have Euro INR, we have Japanese Yen INR, and we also have GBP INR. So these are 4 currency pairs that are directly going with the Indian currency. And then we have 3 cross-currency pairs, which is Euro USD, GBP USD, and JPY USD. So that's the 7 contracts we have. But if you see what we have achieved, it's quite miraculous. India's long-term balanced trend is on this screen. If you see, we have been largely importers for a very long time. Like I mentioned, in 1947, when we achieved independence, we were one of the poorest countries, and we were heavily dependent on other countries for almost everything. But gradually, over a period of time, we have become a little more self-reliant, and obviously today India exports many items, and we are not only an importer of everything. So the growing number of exporters, particularly software, IT, and service exports, means that we have a balanced participation level in the currency derivatives product. India has been a recipient of the savings of the world for more than 30 years. On this chart, you can see the trend of the last 25 years. Foreign portfolio investors have been big sellers only in 3 years out of these 25, which means that investors also want to hedge their currency risk, as they are always watching the return in USD terms. Therefore, they also started participating in this product. India's IT sector is growing. As you can see, we have grown significantly between 2010 and 2023. And according to Morgan Stanley, although software exports are already 50% of the total services exports, Morgan Stanley believes that digitization and offshoring will double the IT workforce in the country by 2032. So the demand for hedging the currency risk is going to go up even more. This graph tells you the story of India's currency derivatives. Although we made a very modest beginning in 2009, gradually the curve has only been going up. And if you see the daily average turnover, it went up to almost 20 billion USD. And on an average in 2023, we saw turnover of about 15 billion USD almost every other day. So the product has been extremely successful. Also in terms of the volume of contracts, we have seen about 20 billion contracts, 4 to 5 billion contracts almost on an average. So that tells you the depth of this product and how well it was accepted. Even in terms of open interest, we've seen huge build-up, both in futures and options. Totally open interest across futures and options is again about $15 billion. I'll just go through some of the key reasons for the success of currency derivatives on NSE. Firstly, I think active participation by almost all investor categories played a big role. Almost everybody, whether it was a foreign investor or an importer or an exporter, even the small, medium-sized enterprises or SMEs, even retail investors, everybody came to the party. Currency derivatives in India are very cost efficient because there is no tax, there are no securities transaction tax or commodity transaction tax applicability to currency derivatives. We are going to see a huge growth in retail investors. We have already seen massive growth. I will talk a bit about this. And finally, I think the ease of market access has played a big role in the success. When I meant active participation by all categories, this is what we saw. And if you see in FY10, the proprietary participation was very high at about 84%. But in FY24, proprietary was only 62.2%. And instead, we have seen a growth in retail, in individual investors, which was 20.9% in FY24. It was only 6% in FY10. So retail has grown in participation. Also, if you see 5% of the volumes came from foreign investors in FY24, that was not even present in FY10. So gradually we saw participation from all kinds of participants. This is the slide that describes to you the cost of transaction. In currency derivatives, the cost is about 1/8 the cost of trading Nifty futures. Because it was cheaper to trade currency derivatives, more participation was achieved. I will talk a bit about the growth of unique investors. When I say unique investors, it means we count investors based on the tax ID. And so if a person has 3 accounts, he or she will be counted as only one. So in terms of unique investors, today we have 92 million unique investors who are trading on NSE. And every month, 3 million new accounts are being set up. This is the pace at which retail is growing in India. So very soon, 92 million is possibly going to be 120 million, 150 million, and so on. This is a massive amount of growth that we are witnessing. And a lot of the retail participants want to trade derivatives. People are much more aware today than what they were 20, 30 years back. This tells you that there has been a 5 times jump in those investors who have traded currency derivatives in the last 7 years. So between FY18 and FY24, there is already a 5-fold growth in terms of the participation from retail investors. India is a world leader in soft infrastructure. We have built what is known as the India Stack, which has the UPI, which is a 24/7 payments architecture built by the government. Around the UPI, we have the Bharat QR, Aadhaar Pay, eKYC, and instantaneous payment service. All of that, together with a bunch of apps, means that India is now digitally possibly the #1 country in the whole world. Even developed countries like the US, UK, and Germany have acknowledged that India's payments architecture and digitalization have surpassed the design in those countries. And so this is something that is making possible greater penetration of investors across the length and breadth of the country. Of course, we have had some key challenges as well in this journey. Currency derivatives are duly regulated by the capital markets regulator SEBI and by the Reserve Bank of India, which is the central bank. There are regulatory curbs around volatility. Derivatives position is linked to the underlying contracted exposure. There are restrictions around trading hours, and there are no linked financial products as they have not been permitted. There's also a bit of competition we see from other exchanges which cannot be regulated by the RBI, and therefore it's a bit of an unlevel playing field for us with respect to those exchanges. There is also competition from the global non-deliverable forwards or NDF market. So broadly, those are the challenges that we have seen, but despite all of this, we have seen the growth that we have seen. In terms of recent developments, the Reserve Bank of India issued a notification in January 2024 mandating the use of currency derivatives only for hedging and not for speculation. So markets are currently in the transitionary phase as everybody is waiting and watching on how best to come out with newer strategies. Markets are definitely likely to bounce back. They will be more mature once the dust settles. In summary, India's GDP, which is about $4 trillion today, is expected to be $5 trillion by 2027 and $10 trillion by 2035. The current market capitalization of companies on the NSE, which is $4.5 trillion, will also similarly grow to $5 trillion and $10 trillion in times to come. India's capital markets can be expected to produce more innovation, more variety of products across all types of asset classes. Currency derivatives will be no exception. As I conclude, I am delighted to share that yesterday we launched derivative contracts on Nifty Next 50 Index. NSE once again is thankful for this opportunity to share our story, and we look forward to sharing the next chapter the next time we meet. Thank you very much.